In our last Stock Unlock livestream, a couple of our viewers brought BJ's to our attention. It's a stock that IPO'd in 2018 and since then has massively outperformed the S&P 500. It's currently up well over 200% since its IPO versus the SPY being up about 40%. So it's more than 5x the returns of the SPY in the past 4 years. BJ's is also sitting near its all-time highs despite the S&P 500 being down 20% year to date. BJ's business is also very similar to Costco, and it's a wholesale warehouse club. It's literally almost the exact same business model as Costco. However, despite BJ's and Costco almost having the exact same business, BJ's is trading at half of Costco's price to operating cash flow, which could give investors an opportunity to buy a very similar business at about half of the price. In today's video, we're going to go through BJ's stock and its business and take a deeper look into it to see if it is presenting an opportunity for investors or if the stock is looking too expensive now that it is selling near its all-time highs. I did a ton of research on this business, and in this video, I'm going to share everything you need to know about this stock. So with that being said, let's just hop right into the video. And just like always, I put together pretty much like a Daniel Pronk slideshow that we're going to go through, and I have a bunch of different screenshots that I took from my research that we are going to go over. So right away, this is BJ's, and they talk about their company. And the first thing that I noticed when I was taking a look through this is that the company was founded in New England in 1984 right here. Now, why I think that this is significant is because we may be heading down this tough economic times right now. Sorry, I got some cat fur in my mouth. But anyways, if we are heading through some bad economic times, then BJ's is a company that survived the dot-com bubble and the Great Recession. Also, 1984 in the 1980s was during a time of very high inflation. So this company has weathered storms, economic storms in the past. So if we enter another one, then it could be a business that does, survive the economic storm and live to see another day. Now, another thing that I noticed here is that BJ's currently has about 233 clubs, 163 gas stations, 6.5 million members, and about 16.7 billion in total annual revenue or total annual sales. So this is basically the business right now. They have 230 warehouses and 163 gas stations, and that is going to be important a little bit later on in this video. Now, if we go to the next screenshot right here, the main thing that I want to point out is where the company is mostly located. So they have, over 200 warehouses across the United States now. And here we can see that they're basically all across the East Coast. So this company doesn't really have any warehouses on the West Coast or in central United States. Now, what's interesting about this is if you're a bull on this business, then you could pretty much make an assumption that this business is going to continue expanding west as it continues building out more and more warehouses, which means that the company could have a very long runway for future growth. But also it will be competing against Costco as it continues expanding across the US. So that would be something to watch out for. Now, let's move on to the next screenshot right here. And basically this one is just reaffirming that the company has over 6.5 million members now, and their member lifetime value is 10 times the acquisition cost to acquire members. This is what I like to see, and this is profitable growth, because think about it. The company is basically spending $1 to acquire a new customer, and then when they acquire that customer, they are getting $10 of value from them. So the company is able to market profitably, and this is really what I like to see, because over the past couple of years, we saw companies that were spending hundreds of millions of dollars on sales and marketing, and they weren't really growing revenue at all. So they were spending all of this money on sales and marketing to try and grow revenue, and it was just like unprofitable spending. And now we're starting to see companies run out of money, and it's going to be a hard time. That is not the same for BJ's. They are having profitable growth, and it's not costing them a lot to acquire new customers. And then when they get those customers, they are getting a lot of value from them. Now, the next screenshot right here is the membership fee income. And we can see that since 1997, it has grown at a compounded annual growth rate of 8.1%. Now, I have some highlighted segments right here, fiscal 2017 to fiscal year 2021, because we can see that the revenue really started exploding from their memberships. The membership revenue is up 40% since 2017. However, the store count has only increased by 5% since 2017. So it looks like more and more members are joining this company, and members are joining BJ's at a faster rate than they can expand their network. Now, another thing here is that BJ's renewal rate on their membership is going up. It was 81% here in 1997, And now in the most recent year in 2021, it's all the way up to 89%. And it has been consistently increasing over the years. So BJ's is retaining more of their members every single year, basically, which is probably because the company is adding more and more value to their members as time passes. So now let's move on to the next screenshot. And this whole slide right here is basically how the company is deploying cash right now and how they think about deploying cash, which is very important to know if you are looking to invest in this business. So the first arrow that I pointed out right here says, highest capital return priority remains on reinvesting in the businesses to support membership, digital, and real estate expansion. So the company is seeing the highest return on invested capital by investing in itself and investing in expanding its network and its warehouses as well. The next arrow right here says share repurchases remains the preferred method of returning cash to shareholders. So BJ's is not focused on paying a dividend. As of right now, they're not going to pay a dividend, and they say that they prefer to just buy back shares whenever they can, and that's how they like to return cash to shareholders. Now, the third arrow here says CapEx ramping up as new club openings accelerate. And here in this slide, we can see that in the year of 2021, BJ's opened up 5 new clubs or warehouses. In 2020, it was 4. In 2019, it was 3. So the company is opening up more warehouses as time progresses, and this is causing the company's capital expenditures to increase. And basically, they're just spending a lot of money on expansion right now, or CapEx. Now, the fourth arrow says that the company has reduced its debt by $2 billion since 2017, and that is very good to see. So the company is also focused on reducing its debt and increasing its book value and cleaning up its balance sheet essentially, and its financial health. And then finally, the fifth arrow says over $400 million worth of shares have been repurchased since fiscal year 2018. So the company is actively buying back shares as well. So basically, when I take a look at this, the company is saying that they are focused on investing in their business right now. They're cleaning up the balance sheet, and if they are going to return cash to shareholders, it's going to be through buybacks and not dividends. So now let's head back over to Stock Unlock, and I want to go and take a look at BJ's total revenue in the trailing 12 months. And you guys can see for yourself right here that BJ's total revenue is growing. It also looks like growth started accelerating right here at the beginning of 2020. And then right here around the first quarter of 2021, it looks like it was kind of starting to decelerate. But since the second quarter of 2021, revenue growth has really started accelerating again. This is what I like to see. And it basically just means that the company's sales are growing and the company is still expanding. Now, if we also take a look at net income, it's not growing at the same rate as the revenue. We can see that it's actually kind of been flat over the past about 18 months, but it is still sitting at an all-time high, and it does look like it is starting to grow once again. So the next thing that I want to take a look at is the cash from operations, or the operating cash flow. And what we can see right here is that the operating cash flow is not at an all-time high, and it peaked in 2020 at about $936 million. And since then, it has been coming down, and now in the trailing 12 months, it's at about $715 million. What we're seeing is the revenue continuing to increase, but the operating cash flow and the net income are not growing with the revenue. So right away, when I take a look at these financial statements, these are questions that I want answers to. And the best place to get answers to these questions is to go and take a look at the company's 10Q report. It's an SEC filing. It's the company's quarterly report, and they explain all of the figures, all of their financial figures in these reports more in depth. So right here, the first thing that I wanted to do was actually take a look at the company's in-depth cash flow statement. And the first line that I want to point out here is the net cash provided by operating activities. And we can see that in the 26 weeks or in the 6 months or the first 6 months of 2022, operating cash flow did in fact decline from last year. It was about $560 million last year, and this year is about $443 million. Right away, I'm like, okay, well, why is this? Like, where are the major discrepancies? And the major discrepancy is right here in merchandise inventories. This year in 2022, so far, the company has had to spend about $45 million on inventory. So that was a cash outflow. Whereas last year, they got a cash inflow of $172 million, which means that they were essentially selling more inventory than they were spending money on inventory. That's not the case this year. They're spending more money on inventory than they're selling. And this was a change of about $217 million year over year. And if the inventory was flat, like if we just set inventory to 0 year over year, then the operating cash flow would have increased by about $100 million year over year. So this is the main thing. But then I also have stock-based compensation underlined here because stock-based compensation is going down. And relative to the company's operating cash flow, the stock-based compensation isn't really that high. It's less than 5%. There is still some stock-based compensation and dilution going on there, but it's not massive. And I just wanted to point that out really quickly because this is a very important figure to note. Now, we can also see right here the additions to property, plant, and equipment. This is the company's capital expenditures. And we can see that they are up by about 30% year over year so far year to date. So the company is in fact spending a lot more on CapEx this year. And this makes sense because as we saw, the company is focused on building out more warehouses and expanding their distribution essentially. So CapEx is going to be high. And personally, when I see companies that are focused on a high CapEx cycle, or they're in a high CapEx cycle because they're focusing on expansion, then I like to pay attention to the operating cash flow figures over the free cash flow figures. So when we value this business later on in the video, I'm going to be using operating cash flow metrics because free cash flow is heavily suppressed right now while they're investing in so much growth. Now, the next thing right here also is just the free cash flow explanation. And I just wanted to dive in deeper into the free cash flow. So this says, free cash flow declined to 254 million in the first 6 months of this year as a result of cash outflows for higher working capital, specifically inventory related due to new club growth and other strategic actions we've taken to better position our business, such as improving in-stock levels over the past year. So right here, when we take a look at their explanation for free cash flow dropping year over year, they say that the main thing was the inventory related expense that we saw earlier on that's associated with the company building out more warehouses. Because think about it, if they're building out more warehouses, then they have to spend a lot on inventory for those warehouses so that those warehouses are stocked, right? So right now the company is investing more in CapEx, and it's investing more in merchandise and inventory to actually fill those warehouses that they're building. And that's why cash flow is down, which we also saw on the cash flow statement. So it's just nice to get, a reaffirmation from the business right there. The next thing that I noticed, so remember, the company's revenue is growing quite significantly year over year. Let's actually just go back to the income statement because we can see right here that in about the second quarter of 2021, the company's revenue growth really started accelerating once again. So I wanted to know, what is this from? Where is this coming from? Like, what is happening? Like, I know that the business is focusing on building more warehouses and everything, but is that where all of this revenue growth is coming from? So I found this in the company's 10Q. Right away, it says net sales for the second quarter of fiscal year 2022 were 5 billion, a 22.4% increase. The increase was due primarily to a 19.8% increase in comparable club sales. The company had 22.4% revenue growth, but 19.8% of that revenue growth came from their same store sales increasing year over year, which would mean that what is that? 2.6% revenue growth came from new warehouses opening or new distribution. So the vast majority of the sales increase was from same store sales increasing year over year. Now, then I went and took a look at this. So this is comparable club sales, 19.8%. Then it says less contribution from gasoline sales, which were 12.2%. So merchandise comparable club sales without the gas sales included was only 7.6% year over year. Why this is so important is because remember, we saw that the revenue growth really started accelerating in the second half of 2021, and that's when gas prices also started going up like crazy. A lot of BJ's sales growth and sales growth acceleration is actually coming from gasoline prices. Because remember earlier on in the video, I said that this company has about 167 or 163 or something like that gas stations across the East Coast of the US. So with gas prices higher, they're making a lot more revenue from that. If gas prices don't remain high, then this could actually be a headwind on this company's revenue growth in the future, because right now, honestly, the majority of their revenue growth is just coming from gas prices being high. That's definitely something investors have to be aware of. I took a look at the year-to-date sales. This is the first 6 months of the year. And without gasoline sales, merchandise comparable sales are only up about 5.9%, so even less than what they reported last quarter. And again, this is very important for investors to know because, again, the majority of the revenue growth is coming from gasoline prices being higher. So now what we're going to do is head over to Stock Unlock's freeform tool right here, and we're going to go and take a look at BJ's price to operating cash flow. And we can see right here that in the second quarter of 2021, the company's price to operating cash flow really started to increase and pick up. It was at about 9.67 in May of 2021, and now today it is sitting at about 14.76. So the price to operating cash flow for this business has increased by about 50% since gasoline prices have started increasing. And that is also when the revenue growth started accelerating a lot quicker. So now what we're going to do is actually bring in Costco, and we're going to look at these two companies' revenue growth before gas prices started going insane. So from about 2017 to 2022, this is all the data we have on BJ because remember, this company IPO'd in 2018, so we don't have the company's financials back to like 1997. So from 2017 to 2020, before gas prices went crazy, BJ's was growing revenue at about 6.6%, and Costco was growing revenue at about 12.6%. So basically, without gas prices spiking, it looks like BJ was growing revenue by about 6.5 to 6.6% on an annual basis, which is also what we saw when we subtracted the year-to-date revenue growth without gasoline included. Remember, it was about 5.9%. So basically what I'm trying to say here is I think that BJ's, without gasoline prices increasing, will probably be able to grow their business by anywhere from about 5 to 7%. That's what the company has done historically, and that is what the company is doing right now without gasoline prices included. It also looks like Costco is a business that is growing about twice as rapidly, which could make sense why the business is valued about twice as high. So I also think that is something to pay attention to. Now, what we're also going to check right here is BJ's revenue versus its operating cash flow. And we can see that the revenue is continuing to go up, but the operating cash flow is declining and really just staying the same. What this ultimately means, once again, is that BJ's operating cash flow margin is going down. And we can see that right here. At the end of 2020, the operating cash flow margin was about 6.26%, and right now it's sitting at about 4%. So the operating cash flow margin has dropped by about 2% over the past couple of years, and the average operating cash flow margin for this business since 2018 has been about 4%, but it overall is uptrending. So if we go back to price to operating cash flow, we can see that over the past 4 years, the company's average has been about 9.53. It's currently selling at about 14.8. And if the margins were normalized, it would be selling for about 11.6, which is still well above the company's historical averages. So basically what it comes down to for me is I just don't know if this business is going to be able to continue growing its revenue at, these very high growth rates, like 22% year over year, because as we saw, the majority of that is from gas prices. So what that ultimately means is that if gas prices do start coming down over the next few years, or even if gas prices level off, then a large portion of the company's revenue growth is going to be shut off. And if the company's revenue growth slows down or maybe even declines if gas prices start coming down in a big way, then I could see these price ratios coming back down to the company's historical average of about 10. This company's price ratios are expanding right now from gas prices increasing. And if gas prices, come down, then that could be a risk for shareholders that I think people got to be aware of. So what we're going to do now is head over to Stock Unlock's discounted cash flow calculator, and I'm going to show you guys kind of what BJ's would have to achieve to be selling for about fair value right now. So as I said, we're going to be tracking BJ's operating cash flow because the company's investing a lot into capital expenditures. And I am going to say that this company is going to be able to grow its operating cash flow at a 10% compounded annual growth rate over the next decade. It's also going to have a 13 price to operating cash flow, which is above how the stock has historically sold. Because remember, historically it's sold at about a 10 price to operating cash flow. And I'm going to say that it's going to buy back about 1% of its shares a year over the next decade, and we want a 10% return rate. Now, when we enter in these metrics, we can see that the discounted fair value for the stock is about $76 or about 1.4% below where the stock is currently trading, which means that it's selling for over fair value if we want a 10% annual return. We can also see that the projected future stock price will be about $197 or about 156% above where the stock is currently trading. So this is what the stock would have to achieve to be fair value right now if you still want a 10% annual return. So basically, if you don't think that the stock can grow its operating cash flow at 10% and maintain a 13 price to operating cash flow and buy back 1% of its shares over the next decade, then the stock looks expensive right now. If we also scroll down here on Stock Unlock, these metrics would say that the company would have to produce operating cash flow of about 1.86 billion dollars a year by the year 2032. In the trailing 12 months, it's produced about 715 million. So it would have to more than double operating cash flow. It would have to about 1.5x operating cash flow over the next decade to achieve these metrics right here, essentially. Now, let's say that the company, the sales growth slows down, gas prices level off, the sales growth slows down, so the company goes back down to a 10 price to operating cash flow, which is how it's sold historically. This would mean that the company is 24% overvalued right now, even if it can grow operating cash flow at 10% a year over the next decade. I think that this is an optimistic operating cash flow growth rate for this business personally, because remember, excluding gasoline sales, this company is growing revenue at 7% a year on the high end. So let's say that operating cash flow will grow at 7% a year on the high end with the overall revenue, and it will trade at its historical average of a 10 price to operating cash flow. This means that the stock is actually about 42.5% overvalued right now and will be worth about $115 a share 10 years out into the future. Basically, what I'm trying to say here is that if the company's revenue growth, sales growth, operating cash flow growth, and price to operating cash flow revert back down to the mean of how it's been valued historically, then it's overvalued right now. And for the company to be fairly valued right now, it has to grow its operating cash flow at a very fast growth rate, and it has to be able to maintain a price to operating cash flow of 13 to achieve that, which I am not totally optimistic the company is going to be able to do. So, in my opinion, I do think that this stock is a little bit more on the overvalued end. That's my reasoning why. Those are my findings. I basically just wanted to share that with you because this is a very interesting case study. When I initially started looking at the stock, I did think that it did look very attractive. Like if you go back and watch the live stream, when people brought up, BJ's, initially I was very interested. I was like, this stock honestly doesn't look that expensive. Like it looks quite interesting until I went through the 10Q and I asked the question, where is the revenue growth coming from? And the revenue growth is the majority of the revenue growth is coming from gas prices increasing, which I don't think is sustainable forever. And if gas prices end up coming down, it's going to be a headwind on the growth for this business, which I think will compress the price ratios over the long term. So that's my opinion on BJ's. That is like my full analysis. That's my full walkthrough. I did a very deep dive. If you guys enjoyed the video, please remember to leave a like on it. It really helps out our YouTube channel here. And if you're interested in seeing more stock analysis and stock market content like this, then consider subscribing to the channel as well. We go live every single Saturday at 11:30 a.m. Eastern for about an hour, where you guys can come and ask us questions and get us to analyze stocks like this. It's basically live stock analysis. We call it Stock Talk every single Saturday. So subscribe to the channel if you want to stick around for that as well. And of course, if you're interested in the Stock Unlock platform, then go and get a 14-day free trial by heading over to stockunlock.com. This is the best platform for investors, you guys. We're building it out. And I can guarantee you that if you join Stock Unlock and you get your 14-day free trial, over the 14 days, you will become a better investor. And you're probably going to see us upgrade the site because we are constantly putting out upgrades. It's just getting better and better every single day. So yeah, we got a lot of great stuff coming. Go and get your 14-day free trial and consider subscribing to the channel, like the video. Thank you guys so much for watching. I truly do appreciate it. And I really hope to see you all again in our next video.